So this budget targets pension tax raid and careful savers disguised in the form of national insurance. So this is crazy. So the government have announced £26 billion worth of tax to be paid by all of us by the end of this decade. This 2025 budget continues to punish landlords, property investors, savers, people saving for their retirement. It really does. We are being hit from all sides as business owners and property investors. This YouTube post is going to be about what has happened in this budget and how you can mitigate some of these problems. So please like and subscribe if you want more tips and advice, but this is hot off the press, what is happening to us all as a result of the budget. So landlords, you are in the spotlight again. I'm sorry. It's particularly hitting landlords owning properties in their own name again. I want to say something really important to you landlords and property developers who are doing properties in your own name and holding them. Please, please understand that as of today, which is the 26th of November 2025, tax is not going to get any better ever. So let's be real and say that if you've got tax things you're avoiding, you need to face them in the mirror. So let's talk about the budget and then let's talk about mitigation. So the good news is that you will not have to pay national insurance on your rental income, which had been threatened in the news running up to this budget. Another piece of good news, and there isn't much, is that for once, that despite speculation, stamp duty land tax or SDLT is not changing for property investors and landlords. Now let's get started with the bad news. In 2027, any money that employees put into their pension will be hit. And the other thing is landlords are going to be getting hit on their income tax. And let me explain. If you own properties in your own name, your levels of income tax as a landlord will rise by 2% in 2027. This is going to be income tax on the higher and additional rates as well as the basic rate. So whereas the basic rates are currently 20% for everybody else, again punishing landlords is going to be 22% for landlords, 42% for the higher rate and the additional rate at 47% respectively. Rachel Reeves said she wanted the wealthiest to contribute the most and that those with the broadest shoulders should pay their fair share. She said landlords are earning $25,000 a year from property paid £1,200 less in tax than comparable tenant on the same income. Not that you have worked and invested into those properties, guys, and invested your hard-earned savings into those properties, but you are not allowed to pay less tax, so you are now going to pay more tax. Reeves said this imbalance was down to the different national insurance rates, which she had also been threatening about, paid by landlords and tenants, but rather than fix the problem, she's raised the basic rate of income tax for landlords by 2% across the board. So please listen on for ideas on how you might be able to manage some of your properties in the future and cover the cost of incorporation using creative property strategies. We'll come to that at the end. The punishment continues for all people who are trying to save for the future. Salary sacrifice, pension contributions, over £2,000 a year, that the salary sacrifice from an employee is to be charged national insurance from 2029. Now these rates of insurance are 15% and 8%, so it's a lot of money. This is effectively a first move towards taxing our pension contributions. You can still pay up to £60,000 per annum into your pension, but it is likely to be taxed in the form of national insurance. Employees as well as employers will pay the NIC's and I think they're 15% and 8% respectively on the amounts above 2,000 for employee contributions through salary sacrifice. Now, from a business point of view, we already got hit. I've got employees, I give people jobs. And this is my company, and we employ people, and we have to pay more national insurance for employing those people now. And you as an employee will have to pay more national insurance on your pension contributions, and so will the employer, okay? So employers getting hit again with that. So most employees making typical contributions, the government says, will not be affected. So this is hard because we are being hit on saving for retirement. Employees can still contribute as much as they want, but they will be subject to the usual limits. Now, the other thing I just want to mention here is that if you save into ISAs, there are going to be some big changes around that, and you will only be able to save 12,000 into an ISA in future if you're under the age of 65, and the other 8,000 you would have to invest in stocks and shares. Look at your tax advisors for more information on that. Mansion tax. So this has been threatened in all the news, and properties worth over £2 million will be subject to a mansion tax, which will come into force in 2028. All homes in bands F, G and H will need to be reassessed before that time. This could hit homeowners and large serviced accommodation providers still paying council tax, which is user class C3 for those who don't know. Now, so this is something that could hit landlords from a business perspective. Now, there are some really interesting things you could be doing with your properties before 2028 to reduce the size of them and put them into different bands. For example, turning them into apartments. Let's talk about that later. So just giving you an idea there. And this will particularly hit people in the southeast. Electric vehicles, if you went and bought yourself an electric vehicle, that's now going to be taxed at 3 pence per mile. And so this is a bit like a fuel duty tax, which is fuel duty. So fuel is taxed at 0.5295p per litre. So this is a bit like that. So if you bought an electric vehicle, you're now going to be paying fuel duty. So it's like that, isn't it? They encourage us to buy these electric to save the planet, and then now you're going to get taxed on your mileage. So I'm not right happy about that. I do have an electric car. Dividend tax is going up. So those who are paying themselves through their business, you are going to be paying more dividend tax. So if you pay yourself in dividends, so directors and investors in shares will see basic rate tax rise to 10.75%, and the higher rate will be 35.75% from April next year, so April 2026. So landlords, whichever way you slice it, however you own your properties, you are going to be hit with higher taxes. The reality is this, that at every budget we're hit harder and harder. Tax is never going to get any better for us, only worse. So structuring your business correctly now could save you a lot of pain later. Now, I know a lot of you have been putting this off for years. I cannot give you tax advice. I am not a tax advisor, but I can, as a fellow landlord, give you a few ideas which you could use to help you deal with some of the challenges. Okay, so the first one is if you own unsplit blocks of apartments, landlords, or multiple units of property on one freehold. You could title split them into a limited company. Did you hear me say that? Title split them into a limited company. The capital uplift would give you as much as 50% uplift in valuation if you already own these blocks. That 50% uplift in valuation will more than cover the cost of any taxes. For example, capital gains tax or SDLT, stamp duty land tax. There is a link in the chat to a free webinar on the benefits of title splitting and how you can get started with this lucrative strategy. You would then go back, number two, you would then go back to get tax relief on your mortgages. So today, if you did this and incorporate properties into your portfolio, we'll start getting tax relief on your mortgages again, and you will be taxed at a lower rate of income tax if you pay yourself through PAYE than if you take your income as a landlord directly. And remember, outside of a company, you're paying that Section 24 tax on your mortgages. So to actually get into a company is getting more and more attractive, guys. And actually, I'm going to talk to you about some little tips about getting into companies in a minute. So number 3, if you own a property in a limited company now, you can save corporation tax by paying contributions of £60,000 a year into your pension. You don't even know this. Most landlords have no idea that if they pay their limited company, and any limited company, right? Any limited company, if you pay £60,000 a year into your pension, it has, well, apart from this NI that's coming in a few years, it's tax-free. So you should take advice on this prior to doing so from your tax advisor. I have a pension called a SAS, Small Self-Administered Scheme. Don't ask a financial advisor about this. They won't tell you about it because they don't earn any money from it. But this is administered by me, my husband, and the SAS trustees. There are lots of tax benefits from having a SAS. Again, click in the link in the chat, come and talk to titlesplit.com, and we might be able to share more information with you about that. At the moment, contributions are tax-free into SAS. In November 2025, I always date stamp what I'm saying if something is tax-free. So if you incorporate 6 or more properties, this is number 4, this is really important. So landlords, you've got a portfolio. Today there is a tax relief still available to you if you incorporate 6 or more properties together. And it's called stamp duty land tax, which will be charged at commercial rates instead of residential rates. Now it's really simple. You can work this out on the SDLT calculator. Rachel Reeves has left this relief alone. So speak to your tax advisor to find out more. So let me give you an example. 5 properties together with a total market value of £1 million sold to a company would cost you $93,750 in SDLT, right? Don't panic, because remember, right, I've already told you, if you're splitting blocks, that £1 million worth of property at block value, right, is going to be uplifted by 50% potentially. So this will pay the tax, right? But let's just go back to the 93,750 in SDLT. However, if you incorporated 6 properties, so this could be 6 flats from a block, right? In the same transaction worth £1 million, the same amount of money, the stamp duty would only be £39,500. So that's a massive saving in stamp duty, and this is commercial stamp duty relief. Now, that might not be available to you in a year's time, so I'd be thinking about getting this done sooner rather than later and getting some tax advice on this. So if you like and subscribe here to our YouTube channel, and you will ensure you are notified of issues affecting landlords, property developers and property investors. I am going to give you one last tip, okay? If you use this incorporation of a block by title splitting your block into a company, we can show you exactly how to do that. We can even give you the perfect power team to do it, okay? If you do that, you have SDLT savings to make, and the capital uplift alone will more than cover any tax bills you've got. Come back soon for more updates on what's happening in property with Rachel Knight at titlesplit.com.